So, Adam Lawrence, welcome to the Scottish Property Podcast. We're delighted to have you on the show. How are you today?
I'm really well, thanks, Nick, and thanks both for inviting me on. Delighted to be here.
Good stuff. Well, I've got a mutual friend, Ross Harper, who's also been on the podcast, and he talks very highly of you. So it was through Ross that you kind of came on my radar, and I've been following you on social media and following your content. You put out some great posts on Facebook. I love the Sunday supplement where you go into quite a lot of detail about the economy and how things are at the moment. So I think in this episode, we'd kind of like to get a lot of your views on what's happening at the moment with, house prices. How is all this going to pan out? This national debt that we've accumulated and stuff like that. We don't want to get too technical because obviously, I'm learning a lot about this as well. Don't know about you, Stephen, but it'd be good to pick up a few things from Adam. But can we just start just go right back to the start and give our listeners a little bit of background about what you do in property and how you got involved with property?
Sure thing, yeah. So starting from these days, I buy single units, blocks of flats, portfolios of properties, 95% of the time plus to hold on to them. So I'm a buy and holder, generally speaking. Try and buy keenly, who doesn't, try and add value, who doesn't. Try and be intelligent about the financial structure and the refinancing and all the rest of it, which I think is sort of badly under-taught or underrepresented in the sort of wider frame of things, because good financing can make a huge difference, of course, as well. So that's where I am today. Few years ago, I was quite involved in HMO. So I've divested all of my private tenants ones, and I've still got a number of social housing ones as well that are on sort of 3, 4, 5, 7-year leases, that sort of thing. And then going back before that, when I started as an accidental landlord, 2008, pretty typical story. Had a property, couldn't sell it at the price that we wanted to achieve for it, so we rented it. Pretty typical. Got ripped off by the agent. Got charged 300 quid one day for changing a part in the washing machine, and thought could have bought a new washing machine for that. So what's going on here? Pretty sure I can do a better job myself of this. So took over management of that myself, and then grew from there, really. Started taking it seriously after interest rates collapsed and the market had obviously taken a bit of a tumble in 2009. So I started looking into it, bought one in 2010, but it was a sort of a semi-intelligent purchase, I'd describe it as, and then started getting more into it in 2011 and grew from there. And back before then, my background is in sports arbitrage trading. So I did quite a lot of gambling without ever doing too much gambling, if you know what I mean, because I would always lay bets off and get into positions where I would always be in profit. Quite good, very lucrative in the early days of the internet betting. Very hard these days because the bookies obviously don't exist to let people like me make a profit, as I'm sure you know. And my very brief and not very illustrious corporate career was in wealth management and financial services. So that's what sort of gave me a bit of a grounding in finance from nowhere really to, somewhat sophisticated, I suppose. And also gave me a lot of ideas that I took from there and have applied to property, like diversification would be the big one, but a number of other ones as well.
Great stuff. Well, we've got quite a experience kind of background then, so this is great because one of the things I love about doing a podcast is we can get access to people like yourselves who've got experience, and we can basically tap you up for some information. So yeah, I've got quite a lot of questions. A lot of it is regarding kind of the current situation that we're kind of facing in the economy and stuff like that, and where do people go? A lot of people are saying, what do we do? Do we buy now? Do we wait? Are property prices going to fall? Obviously, we always say we can't predict this sort of stuff. Nobody really knows what's going to happen. Nobody knew that we were going to be locked up in our houses for a year. So, do you know what I mean? Anything could happen. But we're going to talk a little bit about your investing and what you're doing in property later on. But can we just go and speak about the economy for just now? And one of the first questions that I want to ask you, Adam, is that so many people invest, thousands of pounds on property training and what strategy, they want to decide to do. And people spend like £20,000 plus on training courses and all that. One of the things that I think where people kind of overlook is something that you talk about every week, and it's about what's happening with the actual fundamentals of like the economy and getting an understanding for that. And it's something I've been trying to educate myself. You know, how important is that for people? And do you think they just kind of disregard or overlook it?
I think it's really important, because you can easily get, if you let, I mean, everyone listening to this probably will have known that feeling of a bit of trepidation before they got involved in their first property deal. You know, there's a bit of nervousness, there's a bit of the unknown, and you've got to take that step. And of course, not everybody takes that step. Some people, it takes them years to take that first step, and then they think further down the line, they think, why didn't I do more of this earlier? That's the life cycle of a property investor. They always want to go back 20 years and do more than they've already done because things have done so well, you know. So I think you've got to have, I mean, the last 12 months is a brilliant example. There's so many confusing things that have gone on that you can't necessarily make sense of, especially if you're looking at thinking everyone was sitting last year. How many people sat waiting for months and months saying, well, I'm just waiting for the market to collapse. This is going to happen. That's going to happen. They're looking pretty sick now if they're watching their money be inflated away and are waiting for another crash that maybe is not going to happen anytime soon.
I'm not one of those people.
But that's the thing, you know, it took me about a month, probably the month of April, I'd say last year, to sit there thinking, I started off thinking, this is it, prices are going to come 10% off the top here. And I'm talking specifically about the sort of stock that I buy, which is lower value, higher yielding, pretty classic sort of buy-to-let stuff, really. And then by the end of April, I kind of realised I was looking at the market indicators. I was looking at what was going on. Of course, I was looking at the big shotgun that the government had got out, firing money left, right and centre, thinking, I'm not actually sure the market is going to go down that much. And then I started getting a bit more bullish and thinking, actually, I'm pretty sure the market is picking up here. And then, of course, then the problem, one of the problems you have in property is you get your indicators sometimes 3 months late, you know, so it can be really powerful for that now period of what to do. And also, why not to panic, or why not to be, I always say, don't be a motivated buyer. You know, we always want to try and buy from motivated sellers. But if you become a motivated buyer, you're equally as dangerous. You're in equally as precarious a position as a motivated seller is, because you're going to overpay for something. You know, you're going to make a mistake somewhere along the line. So by sort of giving yourself a grounding in all of this stuff, it can give you an idea of why and what is going on. I'm not suggesting for a minute it enabled me to predict all of what happened last year. As Nick said, no one could predict, you know, what went on in terms of lockdowns and all the rest of it. But it did help me get some understanding and really carry on running my property business and still expanding the portfolio, which was not an easy thing to do in the last 12 months, you know?
Yeah, that's really good points. I guess it could go the other way, and, you know, analysis paralysis sort of thing, where people do get bogged down with consuming so much of this that they end up not taking any action, which I know is what Stephen talks a lot about as well, which is maybe a bit of what I've been guilty of the past year. But I would rather kind of be able to make sort of educated choices rather than, I don't know, I mean, you hear about all the, you know, a lot of the gurus out there, they say, don't listen to the headlines, don't pay any attention to news, pick your strategy, stick to your strategy. If the numbers work, just carry on. So I don't know what your thoughts are on that.
It's a good one. I like to look at the headlines, but I don't read anything into them in terms of, I don't expect them to give me facts, Nick, I suppose is what I'm saying. What I expect them to do is to tell me how the other people or the market in general are being told how to think, are being conditioned how to think. Then what I'll do is go away and look at the raw data and look at what's going on at the Office of National Statistics or whatever and see what's really going on. And then I might watch a few YouTube videos from a few people who are fairly inspirational, like the Ray Dalios and stuff of the world, who are commenting on what's going on in terms of the financial markets and debt and all that sort of stuff, and try and apply that thinking to property. So I like to keep tabs on the news, but I don't think ignoring it is a very good idea. If the news says there's a crash, then psychologically there's a crash, even if there isn't a crash. Now that might only last for a week until the next headline comes out and says, now there's a boom, there's a massive boom happening, you know. So it's good to know how everybody else is being taught how to think is what I'd say to that, really.
What was your thinking last year then, Adam, when you did say in April, you kind of spent about a month thinking about the current situation and lockdown, and what triggered you to realise that, okay, the market's rising and got you back moving in your property business, and then what action did you take?
Yeah, so I think the trigger was definitely watching amount of stimulus that was going into the economy. What was really going on in terms of people's plans? I mean, we were still running. We were able, because we do a lot of remote management already. So we've got quite a lot of real-time raw data information, I suppose, as well from the business day to day. And we were watching people. There was still demand for property. Because we're already remote, it took us about 3 or 4 days to set up our systems to be completely remote. So what we could do is we could still process essential moves. I'm really talking about England here, because we didn't get any tenant turnover in Scotland during that time, interestingly enough. But in England,
are you based in Birmingham?
I'm based in South Birmingham. That's right. Yeah. That's right.
Right, okay.
And we were still able to move people in a COVID secure way. We obviously had to limit ourselves to people who needed to move, but we were getting messages from people saying, I live with my mum and dad, they're 70, they're in their 70s, desperately want to rent a property to get, to keep them safe. I've still got to go out to work every day and all this sort of stuff. So we deemed that to be essential, and we facilitated those tenancies. And I'm really pleased and proud that we did. I couldn't even tell you if we did break any rules, to be honest with you, because I don't think anybody understood all of them anyway. But I'm pretty sure we didn't. And so we had a lot of that, there was still that appetite to move. I'd never seen demand like it. By the time we got to mid-May last year, we had 0 voids across a portfolio of hundreds of properties. We had 0 voids, which has never happened to us before. And so that tells you where the tenant demand side of things were at. And then rents were creeping up and up and up. And obviously there were a lot of people not in the market. But the problem that I had, Stephen, really was I worked out that I definitely wanted to buy quite a lot of stuff. And then I couldn't really get any stock, because obviously Scotland had its own challenges with the register being closed for a period and all the rest of it. And of course, lots and lots of people have held their properties off the market because they haven't been comfortable with the ideas of having viewings and all the rest of it. So the supply side has taken a hammering, and that made it quite difficult to do deals. We did far fewer number of deals in 2020. We just managed to do a few bigger deals that made it a really, really worthwhile year in the end. And some of that is luck rather than judgment, and some of it is just working really hard to try and get those pipelines and get those deals to go through.
So did you look at bigger developments and bigger deals, multiple units rather than an individual home or single units last year then?
Well, one thing that I was working on with Ross, there was a portfolio of 91 units that that came into the top of the funnel in August 2019. So that was due to settle. That was going to conclude on the 23rd of March, which you guys might remember as a bit of a difficult day, let's say. So to say that our great friends who shall remain nameless on this podcast, that they know who they are, who give Ross and I such VIP service all the time and lend us millions of pounds, decided to not even have didn't even ring us up, just told the solicitors, this one's pulled, deal's off, tough luck. Instead of providing the 90% funding they were going to provide, we can do 50%. Surprisingly, on a portfolio of 91 properties, Ross and I couldn't look down the back of the sofa on the day of a national lockdown and find the extra money that we needed. And then there was obviously the register issue as well. So the deal just went into limbo. And then that just dragged on until the end of the year. So that sort of got delayed because of COVID. The other big one that I did that Ross is also involved in was a commercial site. And that whole opportunity came up because of COVID. So the forced closure sort of gave them a chance. They were hanging on in reality. It was a site that was underinvested, lots and lots of potential, didn't really have the management oversight that it needed to take it forwards. And with a lot of the site forced closed, it's got leisure on the site, it's got serviced offices, and it's got some light industrial as well. So it's a mixed bag. And that one's down in the East Midlands, much nearer to me. And that was it's really an asset management opportunity, but also not that easy to finance. So again, we were a bit lucky because our formerly mentioned friends at said finance house obviously woke up in about September, October and realised they hadn't done much business this year. and then were willing to get stuff out the door at possibly terms they wouldn't have been willing to get it out the door on in January or February, let alone March or April, when they basically shut shop, you know.
Superb. So you got these deals and you got the 91 units over the line by the end of the year then?
That's right. That settled on the 18th of December. So ideal time to be settling, and then Christmas, and you forget about it, and then you got to get back to it on the 29th or whatever, whenever we went back to work. So
where were these units based? Were these based in Scotland, or were they?
Yeah, they're all in Scotland. Yeah, so they're in Ayrshire.
They're tenanted. Are they tenanted properties or?
So all tenanted, apart from a few that there was about 3 that wanted auctioning off straight away. So we've already done that, and that's been settled. And then the rest were either tenanted. There was a handful of voids, but again, similarly to England, they've had demand like no other, and we've had much fewer voids and a few outstanding refurb items and stuff to pick up. But that was all really.
Right. And did the bank come crawling back with a 90% loan to value by the end of the year?
Well, they actually missed out on that one in the end. We were very happy, frankly, to be honest, to place that somewhere else, given what had happened earlier in the year. So we actually got an amazing deal on that one because we were purchasing at a discount. They were happy to lend against the full value, not on a bridge. We used a commercial lender called Redwood Bank. I don't know if you guys are familiar with them. They're quite niche, but they do lend. I'd recommend anybody have a chat with them if they've got something that's slightly non-vanilla, because they do listen. They're small enough to really get under the skin of a deal. You can talk to people at the top level in the bank. And because we were getting it at a discount, they would have provided up to 98% of the purchase price, if you can believe that, had the valuation stacked up quite well enough. But like all valuations, there's $5,000 here and there's 10 grand there. And so we had to find a bit more money than that. But we did.
That would make a difference over 91 units, wouldn't it?
Well, that's the thing. But we did that deal, and I'm not sure exactly how much money we had to put into it, but far less money than you should have to put into buying 91 units. I can tell you that much.
What was the end value of these 91 units?
The RICS was about 4.35.
Nice.
That's one of the things that Stephen's like looking into. Obviously, you are, Stephen, doing the buying portfolios and things like that, and you've always said, what's the point in putting all this effort into buying, one or two buy-to-lets when you put in the same amount to get in a portfolio? What do you think? Do you think there's going to be more opportunities, Adam, with portfolios coming on the market? Maybe, tired landlords, more potential tax changes, etc. Is there going to be opportunities there for portfolios?
The mythical tired landlord. I love that, Nick. I think, I find our strike rate on portfolios is lower than it is on individual houses, to be honest, because we get a lot of stuff come across the desk that's not that realistic, or it's been valued at, next door sold for 140k. Well, yeah, it did, but it's been extended. It's got a new kitchen. Yours has had a tenant in for 12 years who's paying far less than the market rent. So where's the real value of something like that anyway in the first place before you start talking about a discount? So, we bought, I would say, somewhere between 8 and 10 portfolios. They've been of differing levels of difficulty. Some of them are like that one, 18 months, that's the longest we've spent in transaction, but you can blame 9 months of that on COVID, obviously. It's all about that reality, isn't it, really? When does the landlord smell the coffee, and how motivated are they? There are people who will look at it and they built the portfolio in the 90s or in the 2000s, let's say, and they've had a lot of money out of it. They've had huge capital gains. They've got no mortgage left on it, and they just think, you know what, it's time to go. When they did the comparables for our portfolio purchase we were just talking about, they gave 3 or 4 other Scottish portfolios that had traded, and they traded at around between 25 and 30% discount. That was the standard discount that they were trading at. Now, a lot of landlords don't know that. They're not ready for it. We were quite lucky with this one because it was spread over the 3 local authorities, and there was a good spread of units. It wasn't like we bought portfolios before where there's 6 in the same street, for example, and the landlord doesn't really understand. It's not something that's being imposed by us, but the lender is saying, well, you've got concentration here. We've got concentration risk. If we swipe this portfolio from you, we can't sell all these straight away because we're going to flood the market in that street. So that takes a lot of landlords don't realise that takes money off. It doesn't put money on. And if you can just diversify your postcodes a little bit, you don't have to go miles and miles away like I've done necessarily. But if you can just diversify your postcodes, you've got a more robust portfolio. So there's definitely going to be opportunity. There's always opportunity. I think, capital gains obviously is the last bastion that hasn't necessarily been touched yet. And that I'm watching that quite closely, because that could depends how well, first of all, if there will be changes made. And then second of all, how do those changes get implemented? Because if you tell, someone that the CGT rate's going from 28% to 40 or 45, that's going to motivate a few people to move some stock on.
Yeah, that's what I was thinking. But it's funny you made the point there about the tired landlords, but like I don't understand how anybody can get tired when rents are rising, 5-6% a year, and then property prices are going up 8% a year. Do you know what I mean? So like,
well, yeah, but the thing is, Nick, if you've got the smaller your portfolio, if you've got one non-payer at the moment and you've got a small portfolio, you've got a problem. If you've got two, you're going to be having sleepless nights, and you've got serious eviction process problems. There's a lot of reasons for people to want to give up, but I think when people do want to get out, what normally happens is it's not about reality; it's about what's in their head. So once your head's gone, I've talked to lots and lots of people who are exiting for one reason or another, and quite a few of them, it's genuine sort of retirement age, and they will, they're business people. They know what they've done. They know what they're doing now. They also understand they're selling to and talking to another business person. So there's got to be something in it on both sides. And they know they've had a mindset shift. They know that they've got to a stage where they say, right, and now I want to go to Spain, Australia, whatever. Now I want to buy because a lot of landlords don't have that champagne and caviar lifestyle like Shelter would like to have us believe, do they? Realistically, we live in street jumpers we got for £3.50. And we're reinvesting everything we've got into our portfolios because we're like, we've got that enthusiasm and we're obsessed with it, and they decide, you know what, I've had enough. It's time to move it on. So unless you can do exiting, if you think about property as a business, like we all do these days, the exit of the business is as important as the build of the business in the first place. And a lot of people wake up one day and haven't planned their exit. And either something changes because someone gets ill or something unfortunate happens, or a big birthday comes up, say they're 65, and they just say, do you know what, it's time. Because otherwise, if I don't do it now, I'm never going to stop, sort of thing. And then where's the plan?
Sorry, Adam, I was just saying, I completely agree. I find that quite a lot of people's diversified reasons for exits, but like you say, they're built up slowly over the years. I've got 25, 30 properties and woke up one day and thinking, shit, that's it gone. It's time to exit. It's not any other, and they've not thought of it. But then I think the way I look at it as well, if you look at the bigger picture, how do you exit if you've not planned it? You would typically lose income by evicting the tenant. You would then, give it a tart up to put on the market, which might be 5, 10, 15 grand renovation to make it hot on the market, and then sell it. But if you've lost the income, then you pay a home report, and then you pay solicitors' fees or estate agents' fees for every single deal. 25% discount is actually what it's going to cost them to sell each individual one anyway.
Absolutely. If people could, that's a really, really good point, and really nicely put, Stephen. And if people could just realise that, it would help them a lot. And sometimes, an exit from a portfolio is something that I've often thought about, whether we should have a sort of side business that helps people deal with exits. But of course, the problem is a lot of the time, these people can't necessarily afford big fees because they're used to the lifestyle of living out of a 100% tenanted portfolio. So when they lose that first bit of income, there's immediately a problem. And like you say, then when are they going to get the 15 grand from? They haven't necessarily got it to do that refurb. So sometimes a blended style exit, especially when you think about capital gains as well, is the way forward. But there's such poor, people would just jump on stuff that's out there. Any agent would say, don't worry, we'll list the lot, try and sell it to their mate, and that's the end of it. So people get put off because it's very difficult for them to exit properly, really.
Good. That's good conversation. I'm loving this, getting into that as well. So let's just go into a little bit more the nitty gritty then, and the economic stuff and the indicators, if you like, because you're really good in this sort of stuff and you always explain it really well. It always creates quite a debate on your Facebook posts as well, I've got to say. Loads of people get hit up about this sort of stuff, about how the market's going and what the government are doing and all the rest of it. We'll keep the politics aside, but if we look at you know, all the kind of measures and all the support that the government's put into this, and, you know, 400 odd billion pounds in national debt that we've got now, you know, the furlough scheme, the stamp duty holiday, you know, what happens when this all ends? How do you think it's going to play out? What are the likely scenarios?
Yeah, that's a brilliant question, Nick. And I think there was a bit of nervousness at the start of this year when the 31st of March, as we started this year, you know, looked as a bit of a hard date for, you know, furlough was ending, or it was ending on the end of April. Stamp holiday was ending. A number of other things that were happening. End of the tax year, so if there were any changes, then they would also kick in. And of course, you know, the governmental policy, without being stated, is kick the can down the road as long as we can get away with it, realistically. That's what it's been at least since 2009, realistically. So that nothing's really changed there as governments have changed and coalitions have come and gone and whatever else. So I think, you know, we've got a tapered, I mean, I know obviously in Scotland, the holiday's over, isn't it?
Tomorrow, 31st.
Close of business tomorrow, it's over. So,
yeah.
You know, the lucky ones of us down in England are going to get to see the impact on the Scottish market. And that's the sort of thing I'll be watching very closely, because we've got a real life example here that's going to play out. I imagine the Scottish conveyancers are quite hard to get hold of today and tomorrow for that reason, really. But that's sort of where it's at. So we're going to get a bit of a dry run there, aren't we?
But I think though a lot of people were saying in Scotland though that it was never needed in the first place. Number one, because like you say, with this shortage of supply coming on the market, it was always going to keep quite buoyant and prices were going to stay up. And then, you know, other people are saying, well, you know, it only saved you, I don't know, because for us up here, it was only up to the value of 250,000.
Yeah.
And it wasn't, you know, property prices up here a lot lower than the likes of like London. So I can see when it ends, London market really being affected. But, you know, I don't know about the rest of the country down there.
It's interesting you say that, Nick, you know, because if you talk to people in the London market, they say, well, you know, I mean, it's 15k it saved them. But if you're buying at the 2 million level, it's not the money that has necessarily motivated you to move so much. And actually, a lot of the London transactions have been people moving out of London and then selling to investors, overseas buyers, things like that, to get a lot more for their money out in the leafy suburbs or whatever. So I think it's probably had more of an impact in markets similar to where I live, where, you know, 500 to a million is a really, really active part of that market. And it's definitely supercharged the activity in that at that level. But I think, you know, going back to the question and what you were saying about, you know, when does this end and all the rest of it, obviously you've now got furlough kicked out till end of September. And then you would imagine, because we saw a little preview of it, didn't we? Rishi wanted to get us onto a job support scheme rather than a job retention scheme. And that was what was going to happen from the 1st of November. Now, that had to be scrapped entirely and furlough had to be continued as it was. But I'd imagine there's still scope for a job support scheme from the 1st of October. And I expect to hear more about that in the sort of coming months. I'm of the belief that lots and lots of people at the moment who are on furlough are either been in forced closed industries, so take the whole of leisure, the whole of hospitality and all the rest of it. You know, you have to break all these numbers down, but that's over 1 million people right there. Travel, obviously lots of people still on furlough. Then you've got the use of strategic furlough. So companies like Magnet Kitchens, for example, they furloughed their staff in December and January, just because December and January are quiet months for Magnet. I mean, what a great business decision, but it's not exactly in the spirit of the job retention scheme, you know? You've had lots of people, I mean, football clubs famously putting people on furlough and getting pilloried for it in the press, probably quite rightly, to be honest. And so how many people on furlough are actually going to lose their jobs when furlough does finally end? I would argue probably not that many, to be honest. And I've been arguing down and down and down on the forecast unemployment rate for about 6 months now. And in that time, the forecasts have come down from about 9% to about 6.5%. You know, and we're about 5% today. So I'd also say, bear in mind, historically, 6% is a low rate of unemployment. And we're at 5% and moaning about all these jobs that have been lost. We're not living in the real world on that stuff at the moment. Yeah. And then there's other problems with these high-level metrics, such as counting the number of jobs there are is not really what you want to be doing. Because apart from anything else, how many of them are part-time? How many of them are flexible? What's changed in terms of flexible working? It's a massive. It's the biggest change in 50 years for employment, I think, realistically. So unemployment is not particularly worrying me. Inflation is not a particular concern today, but I think we're pretty much guaranteed a reasonable lump of inflation at some point in the relatively near future. What scares me a little bit is how quickly things have moved throughout this whole crisis. So normally speaking, the economy is obviously a bit like a super tanker, or not getting stuck in the Suez Canal, hopefully, but it moves particularly slowly. And a lot of stuff during COVID has moved incredibly quickly. So we're not really well set up for that. And inflation's a bit of a dangerous beast, really, because if you let it off the reins, then it can really run away, and too much inflation can really hurt an economy. And we haven't dealt with that since the 70s. And a lot of that, the winter of discontent and all the rest of it, we're going back to before when we were all born here, realistically. But that was a big factor of that was the oil price shocks and not being able to control the economy in the 1970s. And then we had a complete bloodbath, obviously, in the early 80s. We're leaving politics out of it, I know, but Margaret Thatcher, etc. I'll just leave that there.
Don't mention her in Scotland.
Well, exactly. I'll leave that one. You can edit that bit out, Nick. That's fine. But so you've got unemployment covered there. You've got inflation covered there.
Can we pause on inflation, right? Because
sure.
There's been a huge, a lot of this in the press and stuff that I've been reading, and I don't really know if I understand it, because like you say, we've not probably in my lifetime, yours as well, you're only a young guy as well, mate, so like you said, the last proper inflation that we dealt with was back in the 70s, right? Mm-hmm. So like probably none of us have really experienced it properly, so how does that work then? Inflation, basically the price of stuff goes up, right?
Yeah.
To put it bluntly. If we're investing in property and assets, how does it affect that?
Well, I mean, what you want in an inflationary environment is you want hard assets. So at a simple level, if the price of everything is going up, it's being driven by the price of goods going up, but also the price of wages going up. Household incomes are the single biggest driver of property prices upwards, behind the availability of credit. And, we saw evidence of that in 2008. What happens if anybody can get a mortgage? Guess what? Anybody tries to, and then they start gambling on house prices. House prices start spiraling upwards, and then, like all good bubbles, it bursts.
That's not going to happen this time, though, is it?
Well, I don't think it is, because this time is much more likely to be supplanted by also wages going up, or even more importantly than that, maybe disposable incomes going up, because 6 or 7% of people's incomes, generally speaking, on average, are spent on traveling to work. Now, if you take that 6 or 7% out, that's a serious. That's like if you need to go to the office one day a week, you found 5% of your disposable income overnight, like that. That's more money in your pocket at the end of the day. What are you going to do with it? Well, historically, we've been a society that spends it. Now, at the moment, what you've got is you've had a massive expansion in the money supply because of all these grants, because of furlough, because of bounce back loans, because of all the rest of that stuff. But you've had a massive decrease in the volatility of that money. How quickly does that money get spent? Because if you think about it from the government's perspective, you go out and spend £1 on a loaf of bread, there's VAT on that, then that money gets spent on something else, and all of that generates tax and generates economic activity. That multiplier effect has been shrunk during COVID, because what do we all do? We sit back in our homes, we're scared to death, we're hoarding money. Even if we want to buy deals, it's quite hard to buy deals. So we're building up bank balance. So the money, doesn't matter how much is out there, it's not being put into economic use. Now, when that changes, and there's not been a lot of discussion about this. I haven't even written about this myself, but I do want to write about it in one of my future supplements. But we don't know how quickly that rubber band will come back from, okay, everything's open. Now, a certain age demographic is going to go mad, I think, realistically. They're going to make the most of it. But there's a lot of people with a lot of money who are sitting there, if you were going to pick an age arbitrarily, 50 plus, who aren't going to go crazy with all this money they've suddenly saved up, right? They're going to be quite cautious. Yeah, everybody wants a foreign holiday and all the rest of it. Everybody's going to want to do that sort of stuff. But I've heard people who are in there maybe 50, 60, 70 saying, well, we're not going to get on a plane this year, regardless of what happens. Yeah. Not interested. Want another year to see what happens. So the rubber band might not be as fast as something, and we don't really want it to be as fast. because if it's really fast and all that velocity comes back, that'll be inflationary straight away. And that could be quite damaging and lead to sort of knee-jerk reactions. I don't think that is going to happen. But ultimately, hard assets do well during times of inflation. So gold is a classic, does really well, but as a store of wealth. And that's why it correlates, that's why it moves upwards when other things are moving downwards. Stock market does badly. Look at the stock performance in 70s and early 80s, and you'll see it was an absolute bloodbath. You know, bonds will do really badly because ultimately they're priced based on yield. And if they're only returning 1% and inflation is 4%, you're losing 3% a year in real terms by holding on to bonds. So nobody wants those either. So you've got significant index-linked bonds linked to inflation will be incredibly popular. You know, so it affects all of these things. And of all of those things, property, the closest thing that property is to those assets is gold. But the benefit of property over gold, of course, is that it yields because it provides a rent in real terms. Now, if wages start, now what happens is goods get more expensive, employees start to demand higher wages because they can't afford what they could afford before. So wages need to go up. So prices need to go up in the goods that the companies are selling. So it all starts spiraling up and up and up like this. But when all that happens, rents are going to go up to keep up with inflation, ultimately. And then either, if property prices didn't move, obviously yields would get better. And you've got to put this in the context of the zero interest rate environment. The higher the yields, the more attractive the property becomes. So the property prices get bid up to keep up with that yield.
Yeah.
You know, because people, and this is why, another reason why prices have done really well in the last year, if you're getting zero in the building society or the bank or whatever, then, okay, if you're only getting a net yield of 3 or 4% a year on a property, you know, you're not using finance, it's a hell of a lot better than, you know, even if you got a 4% net yield on your rents last year, but you got an 8%, 8.5%, 10% growth in some parts of Scotland, you're in a fantastic investment. You know, you've done brilliantly. So it all starts to look attractive and it all starts to get bid up. And then, of course, if today you take out a loan of 100K against a property that's worth 200, and the property price, it doubles in 10 years, as all the gurus tell us it always does, even though we all know that's a lie, then that's worth 400K at the end of it, and you still only owe 100. So that leverage has had a massive impact. You're still paying back the old money number, but you've got the new money inflated figure as the value of the property. So it's massively helpful to a degree. But when you start going over, say, probably, and you have to work out on today's, you know, you can look at the 70s and say inflation was 26% and this, that, and the other.
26%, is that right?
There were times when it was, yeah, absolutely. But you've got to put that in a backdrop context of interest rates were in double digits as well.
Yeah.
So this is why you have to look at the real yields rather than, you know, to us at the moment, 3% inflation would be high, 4% would be really high. Above 4 would have me really, really nervous because it starts potentially running away and away, and then people lose confidence. You know, the economy suffers. Companies don't want to invest. They don't want to employ people, and it turns into a bit of a negative spiral. Everyone just goes into a cost-cutting phase, and then there's no growth in the economy and nothing to sort of push us forwards.
Is that why they say, you know, in a scenario like that, you know, the rich get richer and the poor get poorer, and that divide gets kind of bigger?
Nick, if I've learned anything in the last 12 months, it's the rich always get richer and the poor always get poorer. You know, I mean, look at what's happened with the whole COVID situation. It's just, unfortunately, you've got to put yourself in a position where you can be on the one side rather than the other. That's all I can say about that, I'm afraid.
Yeah, I've just tried to put it, it's really well explained about inflation, and, you know, it seems to be a thing that's really getting talked about hugely at the moment.
I love the podcast and having guys like yourself, Adam, because you do explain that in such a great way that numpties like me can understand it and use it in that business.
What about potential? Because obviously, if you're sitting on a portfolio, like I've got 10 properties, right, and I'm thinking, how potentially could I get exposed or lose out here going forward? I mean, one thing is, you know, interest rates. I mean, you talked about interest rates there back in the 90s or whatever it was, you know, being like 13, 14%. But that ain't going to happen either, is it? I mean, what's the deal with interest rates? How could they? Why would they start either pushing up interest rates or putting them in some talk of negative interest rates? You know, just touch on that for a bit.
Sure thing. So you've got to put into context again the backdrop of the whole thing. So zero interest rates, which is basically where we are now, are usually traditionally used in times of recession to make it really, really cheap to borrow, not just at the governmental level, but at the company level as well. So it's a time to invest. If you take a really simple example of a factory, it needs machines in order to be more productive. It's a great time to get machines on credit because it's not costing you a lot of money, but those machines will still yield the production that they've always yielded. It's just a lot cheaper for you to invest in them, realistically, from a financing perspective. So that's why interest rates have been zeroed at the moment. Now, you've got to bear in mind, economics at the moment tends to reset itself about every 10 years. 2008 happened and they threw all the textbooks on the bonfire, and 2020 happened and they kind of done it again in many ways. But traditionally, the interest rate would be used primarily to control the rate of inflation. So interest rate goes up, therefore the reverse of all of that happens. Companies get less confident, gets more expensive to invest and all the rest of it. So it tempers things off. So instead of that inflating, overheating economy, it starts to bring it back down again. And the idea should be, it's a bit like a seesaw. Now that relationship's been broken because we never reset that relationship after 2008. So that then moves you into a period where instead of, when you talk about controlling the interest rate, it's what the economists call monetary policy. It's effectively what they're doing. Now, monetary policy has effectively lost all its effectiveness because the interest rate is as low as it can be. They've fired all their bullets. There's a gigantic amount of quantitative easing, nearly £1 trillion worth of QE in the economy. There's not a lot more in the locker there. Another 100 billion, crazy as it sounds, won't make a lot more difference. So then you have to go over to what we call fiscal policy, which is effectively governmentally controlled. So it controls the tax rate. It controls spending and inflation and overheating in a different way. And when you put tax up, of course, what you do is you lower the incentive of the entrepreneurs to produce money and for people to work harder. Of course, that's one thing that you do. But you also, in theory, should take more money in terms of tax receipts, although it doesn't always work like that either. But it has an effect of cooling down the economy. It can also be inflationary depending on what taxes you put up. So if you put VAT up, for example, then everything gets 4%. If you put it up 5%, everything gets 4% more expensive in the shops. So there's an immediate inflation gap upwards, or the companies have to operate to lower margins. But all of this suppresses economic activity, and that's where they will be using tax as a weapon because they don't have many weapons left to use in the future few years. So some of it will be dressed up as we've all got to pay for this crisis and all the rest of it. But actually, it's quite intelligent sort of economic tinkering at the macro level. And the Bank of England, the US Federal Reserve have been a lot more open and honest and said, look, we're not putting rates up for 5 years. So they're basically saying we're going to let inflation go and we don't want to put the interest rate up because they're borrowing. This is the thing that you appreciate. Obviously, the US figures are bigger than ours anyway.
Yeah, you think we put out a lot of money. Wow, you look at their trillions, And
the thing is that their economy is about 7 times the size of ours, but they are putting in more than 7 times more money than we have. Compared to the EU, the US, the OECD in general, we actually stack up quite well as not having spent that much money during this whole thing.
Do you think we can get an indication? Do you think we can get an indication of what's to come? If we, I don't know if this is the way it plays out, but can you look at what's happening over there and say things start having a real impact on the housing market over there, and house prices start falling? Will that eventually filter through to us, or is it not really as simple as that?
It's a really good question. It's quite a tough one because obviously when a real big event happens like an 08 and there's a credit crunch, that credit crunch happens worldwide. We had very similar lending policies to a lot of the US banks, the ninjas, no income, no job, no assets, and all the rest of it. So effectively that was replicated over here. We're doing some of the same stuff as the US at the moment, but nowhere near that level of stimulus. They've been giving what we call helicopter money. So they've been giving people checks into their bank to say, there's some money. That's the most inflationary thing you can ever do because it's money direct to the consumers.
Yeah.
And generally speaking, like us, the US is a very consumption-driven economy, and it's a very credit and debt-driven economy. So there's a lot of similarities, but of course the property market is tougher because the land scarcity isn't there like it is generally speaking. It obviously is in cities and all the rest of it. But it's not really there like we have. I always look at it as when they build a new housing estate, generally speaking, if it's houses, ignore flats for the minute. But if you build a new housing estate, it's in an inferior location normally, right? The houses are smaller because the developers are trying to make a margin. The roads are thinner and they're more expensive. So generally speaking, it's not all that attractive to buy new builds, especially when you think like we do as investors, generally speaking. In the States, it's slightly different. You know, they throw them up, single skin, timber walls, you know, build a house in a week sort of job. And all the roads are straight. Everything. It's not necessarily the case that it's going to be an inferior development. And there isn't that sort of, I mean, obviously they do zoning. They do have an element of control over their urban sprawl, but it's not like our greenbelt. You know, we choke off urban sprawl with greenbelt around towns and cities and villages and all the rest of it. So they don't have that, you know, element of scarcity of land that we do as a general rule. And obviously there's bits of rural Scotland, just like there's bits of northeast of England and all the rest of it where that isn't necessarily the case. There isn't that shortage of supply, but it does apply to a lot more of our stock than it does the US. So it depends where the movements in the US market come from, really, Nick. I mean, we've obviously got significant constraints at the moment in terms of, you'll have seen materials are up about 12 or 13% year on year, building materials. Labour prices are up. Getting contractors at the moment, it's not that easy. We're finding in different parts of the country. Some of that is due to restriction of movement because of COVID. I'm sure some of that is down to Brexit. We've said all the words we can't say now, so that's covered all of them. But you know, there's a real difficulty that's localised to the UK as well, whereas the US has got different challenges in its housing. So not necessarily, but it's always good to look at the US because they do tend to move more quickly. You know, bear in mind in the US, you don't have the employment rights you've got in the UK. You wouldn't get redundancy and things like that. When COVID came, what happened? Bang, 25% of people unemployed within about 3 weeks. That's what happened. Now, they upped they didn't do furlough, but they did unemployment benefits up to $600 a week, a massive increase in that for a 3-month period or something, I think it was. $1,200 checks, $600 checks, all of this. Let's just fire the gun, throw money at people.
Helicopter money, like you say. But I want to bring you on to something that I was actually, I'm sure I heard you discuss it in a podcast. And it's the institutional investors. I think it was yourself or the guy, Rod Turner, maybe as well. He's got a podcast. But they were talking about, you know, like likes of Lloyd's Banking, I think, and John Lewis, and these big kind of corporates and the institutional investors, legal in general, getting into residential property when traditionally it was more commercial, was it, that they were involved in? And what impact is that going to have? And why do you think they're getting into this now?
I mean, let me just say one thing first. I probably shouldn't say, but one of the local Lloyd's relationship directors is quite a good friend of mine. And I spoke to him after I did that podcast with Rod. And he said, well, look, from all our internal meetings so far, we're not actually sure that statement is true. They've got no plan at the moment to do any of this. But I do think that is the future of the market over the next decade. Whether it's Lloyd's or whether it's not Lloyd's is somewhat irrelevant. You know, Aviva have been getting involved in it for years and years, and they were right at the forefront. Their first build to rent scheme was 2009, right. Believe it or not. So there are the big players, the big institutions are going to be in. I think you go back to what we were just talking about, and we're in a zero yield environment for a lot of stuff. Equities, yes, they're doing well, but then there's all this QE that gives this false money in the markets that, you know, the drop of the hat, the market's dropped 500 points if someone says they're going to withdraw the QE and all the rest of it. So it's difficult to have too much confidence in all of that. So they're looking for returns. And going back to what we were saying, if they can yield, you know, without debt, 2.5%, 3.5%, 4%, you know, and you don't need an incredibly high yielding portfolio to do that. I'm talking after costs, obviously, you know, then these guys, the pension funds, they've got obligations to pay. And of course, they've got a problem, an ever increasing problem. We're all living longer, generally speaking, you know, and we're not necessarily working any longer than we did, although I think that is creeping because pension age is going up. And I think by the time we get to our 70th birthdays, maybe that's about where we'll potentially retire Not that any of us are planning on retiring off the state anyway, realistically.
No.
Most of us don't believe the money's going to be there, apart from anything else. But you know, they've got to look somewhere for returns. And if you appraise property every day and lend against property every day, there is an element of sense in also appraising property to buy every day, you know, and holding big portfolios. But they've got a massive challenge, because the biggest question, Rod's done another couple of podcasts with, he did a great one with a guy from Patrizia, Alan Chilton, who head of their resi. They've got something like, it's something like 27 billion of resi across Europe. So I mean, serious players. And their challenges, generally speaking, are in, and you guys will know this, the property management side and keeping the costs reasonable. Yeah. Because there's a lot of, say you look at a housing association when they get rid of some of their stock, right? People think, why does the housing association sell a stock through an auction, right? Well, one, to show there's no conflict of interest, right? And two, to get the best price in the quickest possible turnaround time. But three, you or I might be able to refurb that property for 10 or 15K. Whereas if the housing association does it, then it's probably going to cost them 30K because they've got so many more hoops they've got to jump through. You've got so many more stages in their process that we make up for by, we go to the front door, we do the schedule of works ourselves, et cetera, et cetera, et cetera. So there's value on the table there. And these big guys can't compete with us at that individual house level. It is impossible for them to do that.
Well, yeah, I'm presuming that they're not going to be like, you know, employing sourcers to go around Ayrshire and snap up, you know, £50,000 properties and stuff like that. Do you know what I mean?
No, they're going to have minimum ticket sizes as well. I get a lot of messages these days, and I never know whether they're real or not. I'm sure some of them are and some of them aren't. But they're saying, you know, we've got 20 million to deploy, we've got 50 million to deploy. Have you got anything that's yielding 8%, whatever? It's like, do you want to buy the whole of Ayrshire? You know, I mean, I don't know what you think I can deliver you for that money, but it's not, you know, it's not feasible. But and the other thing I'd say, Nick, is that they've also got to think about their reputational risk. So people don't like, you know, big institutions are a little bit worried about letting property because part of the inevitable life cycle, and it does only happen in a very small percentage of tenancies, as you know, is eviction. And if Lloyds Bank evict you, do Lloyds Bank want you going on Twitter or whatever and saying, Lloyds Bank have treated me disgracefully? This, you know, it's a very sensitive and very difficult process to go through fairly and properly. You know, so you need quite a high level of skill, and that negative impact on their brand might be worse than the positive returns from investing in property. So there's a lot of challenges for them to work through. And I think what you normally find is if you look at someone like some of the little mortgage lenders, like the mortgage packages like Fleet or Foundation or people like that, they get their money from someone like Lloyds or HSBC, right? They get a big slab of money and they get a big list of tick boxes of what they need to do to lend that money. And so Fleet or Foundation do all this hard work at the front end, and that enables them to move the money from HSBC to the property as security, right? So if something ever happens, if Fleet have to take possession, nobody knows that HSBC are the funders behind Fleet. So HSBC have no reputational risk. So I wouldn't be surprised if a similar sort of set of organisations get set up, something that looks like a letting agency, maybe, but it's more like an investment house letting agency that can provide, but like we say, the volume that these guys are looking in, if someone came to you and said, right, Nick, we've got 20 million to spend, but here's the criteria, and it's got to be 20% below the home report or whatever the criteria is. It's not going to be that easy. Whilst it would be a good night, you then think, wow, how the hell am I going to deliver all of this? You know, who are these people who can deliver this level of stock? I know the people who can build it, but I don't know the people who can buy it below market in the secondary market. That's not going to be an easy thing to do.
Yeah, so it's probably going to be like more of the build to rent market and the new builds and all that sort of stuff. Yeah.
I think, and then we've seen, I don't know if you guys have seen the headline, but Goldman sold a £160 million build to rent portfolio up in the Northwest earlier this year. Right. And that was sort of heralded a bit as, right, this is one of the first ones to change hands, you know. Yeah. So I've had a few messages on the back of that saying, oh, can you find me anything at this sort of level? It's like, the trouble is the people who've done the build to rent, they're not sellers, generally speaking. They're insurance companies, pension funds that have money to pay out every month. So if they need the money to pay out, they need the rent. They don't want to sell the yielding asset, you know, so there's not going to be a lot of transaction volume. And of course, that suppresses the transaction volume just that little bit more. and makes it ever harder for the agents, because you think, oh, well, we build 200,000 homes a year, let's say, but if 50,000 of them are built to rent, they're never coming to the market realistically, you know? So it's interesting dynamic.
Well, we've only got about 5 minutes left. In fact, we need to kind of wrap up shortly because we've had you on for just about the hour. So, yeah, apart from writing these columns for the Financial Times, kidding on, which are amazing, by the way, everybody go check out. Is it Facebook that you post these articles?
I post them on my timeline and on Partners in Property, our Partners in Property page as well. Yeah.
So go and check them out. But apart from that, what are you kind of focusing your efforts on now in terms of the property investing? I know you've been buying up some in Scotland. You know, why Scotland? Where are you looking to take the opportunity this year?
So, I mean, it's a pretty easy. I mean, there's two reasons really for Scotland. One is Ross. So that's a definite reason, because he's been an incredible business partner and very inspirational.
You've just froze. On you go.
Sorry. The other reason, apart from Ross, is there's extra yield, or the other reasons, if you like, there's extra yield. I find the system to be fairer and more reasonable than England, generally speaking. There is a little bit more that maybe is in favour of the tenant, but I don't know whether, I'm not just saying this because I'm on the Scottish Property Podcast. People do seem to be a bit straighter. We don't get as much difficulty or let's say, tenants being a little bit flexible with the truth as we do in England. But there is that extra yield. There is that opportunity. I love the home report system. I think it's brilliant. It's a shame they never made it work in England. It makes buying so much easier. I can't tell you. It's much easier for me to buy a property in Scotland with a home report than it is for me to buy one that's 2 hours away in England. Yeah. Because I just haven't got that level of detail. It's brilliant that it's provided, and it's obviously for us as the purchasers, it's provided for free. System works well. Not as much competition, so don't worry. I'm not going to tell everyone about it. Hopefully, there aren't tens of thousands of listeners to the podcast, Nick. But no, not as much competition, which makes it a little bit easier. And there's enough stuff that people get scared over stuff they just have no business being scared of. So, the law's different. Yeah, it is. And there are, I didn't know what the articles of Roop were a few years ago. Do you know what I mean? But there's not that much difference in the two systems, realistically. And
we still don't know what the articles of Roop are.
neither do I, but I didn't want to say that on the podcast. Yeah. But there's not too much to be concerned about. A lot of people still think the system is your word is your bond. If you've sold it, then you've sold it, which obviously is not really the case these days in Scotland. But that's helpful as well. So we don't have as many deals fall through. I just find that people are a bit more realistic, to be honest with you, Nick. I think, vendors, we were talking about portfolios earlier, and one of the big bugbears I have is portfolio vendors who are not realistic, and you can burn a lot of time when they're thinking they're going to get absolutely top back for their property. Like I say, because next door sold at that price, they think that's their price. It's just crackers. Whereas the home report's there to say, here it is, here's the comparables, here's the problems with the roof, here's all the rest of that stuff. And then we can transact on that basis. I love that. So there's a lot to like about it. And I also think I did have a bit of a wobble because I was worrying about independence. And as you said, we're going to keep it apolitical, obviously. But what I then read, and this might perturb a few people, I suppose, but I read a really interesting column from a really top economist who said, if Scotland goes independent, the likely way forward for Scotland will then to be a period of mass immigration, because it will need those workers to drive the economy, right? Now, if you take that as a reasonable argument, then you would think, well, actually, mass immigration means more homes needed. It means definitely more rental stock needed, because people who migrate into a country generally need to rent to start with anyway. And actually, it could be a really positive thing for the market. And I'm not saying that's guaranteed to happen by any stretch of the imagination. And I don't know what mechanics there would be in terms of rejoining the EU and all that. And then would it be Schengen, and would it be all the rest of that? Of course, I don't believe that the SNP knows the answer to that, but we've said it's not going to be political. But none of that scared me off Scotland. And I actually thought, you know what, there could be a real upside in that if independence was to play out. And then, of course, other stuff's happened since then, as everybody knows about at the moment.
Yeah, we'll just take all the coronavirus handouts. We'll take all that money, and then we'll just leave you. Yeah, we'll leave you to pay off the debt. But no, I don't really get involved in the whole independence debate.
Probably best.
We'll not get into that on this one as well. So yeah, just obviously, no, that's great. In terms of where people can reach out to you and find you, just want to give a shout out for that.
Yeah, sure thing. So Facebook's always good. I'm also on LinkedIn, Adam G. Lawrence. I do share some of my articles and stuff on there as well. So that's the two easiest ways to get in contact with me, Facebook and LinkedIn.
Excellent. Well, I'd like to thank you very much for your time today, Adam. I mean, I love talking about all this stuff because it's just learning for me. I'm absorbing it like a sponge. I think more people need to get kind of financially educated as well as find their strategy. And there's nothing wrong with going on courses and property training courses, like, you know, if that's the right thing for you, and to get yourself a clear plan. But I think the fundamentals of any investing are always going to lie there, and it's good to get a better understanding of that. So thank you very much for your time.
No, thanks both very much. Really enjoyed it. Thank you.
Thanks very much, Adam. Appreciate it.